Nigeria's annual inflation rate dropped in December after the Statistics Office revised its calculation method to prevent an artificial spike that would have pushed inflation to 31.2%. With the new approach, consumer prices rose by 15.2%, down from 17.3% in November. The agency also updated year-on-year inflation rates for January to November 2025. The new methodology uses a 12-month average index, 2024 being 100, instead of a single month base. Tilewa Adebajo CEO of CFG Advisory commented on the update, and the Central Bank's Monetary Policy Committee is expected to pause any rate moves as it reviews the new data and have a better understanding of what this all means.
Inflation at 15%, as announced yesterday by the National Bureau of Statistics, puts to rest the controversy that surrounds the inflation data and also calls to question the integrity of this information, especially since the Monetary Policy Committee has not responded with commensurate interest cuts based on the inflation data. So invariably, the true tests of these inflation numbers will come if at the next Monetary Policy Committee meeting, the members agree to significantly cut rates. However, having said that, the corporate finance group, based on its research using the adaptive gap measure, puts inflation currently at 21%, which reflects the reality on ground in Nigeria today. What that means in the outlook for 2026 is that we all agree that despite these divergent numbers, inflation is on the decline in Nigeria. The question now is, how far has that inflation gone? So in 2026, I think what we expect without a doubt is that inflation would probably towards the end of 2026 be closer to 15% as to what is being called today. But based on government numbers, I think the government figures you'll begin to see a 10% inflation rate by the end of this year. So hopefully by the end of 2026, the controversy and surrounding this rebasing and all the necessary corrections would have taken place, and Nigeria can finally begin to plan its growth strategy to continue to restructure this economy and to lift 140 million people out of poverty by growing the economy at 8 to 10% per annum, and with reduction in inflation, restoring purchasing power to consumers.
Hello, this is Global Business Insight, where we bring perspectives to help you interpret trends and navigate the context. Business executives and leaders in governments and other organizations say they see turbulent times ahead. The World Economic Forum, in their latest 2026 Global Risk Report, which surveyed 1,300 leaders in government, business, and other organizations, saw geoeconomic confrontation leaping to the top spot on the list of business worries over the next 2 years. This was fueled by increasing competition and weaponizing economic tools like tariffs, regulations, supply chains, and capital constraints. The report also adds that it could lead to a substantial contraction in global trade. The report says the downside of artificial intelligence technology-related risks are also of fresh concern. Societal polarization has joined the top 3 risks as a rising geoeconomic confrontation is seen as more urgent and misinformation remains a major issue. Economic risks are more erratic, less predictable, and manageable, and concerns indeed growing over an economic downturn, rising inflation, and potential asset bubbles as countries face high debt burdens and volatile markets, according to the report. The report confirms that a contested multipolar landscape has now emerged where confrontation is complicating collaboration and trust, the currency of cooperation, is losing its value. While I agree that turbulent times lie ahead, it is important for markets to dwell on the post-turbulence period and to consider appropriate positioning for a potentially different global order, which remains challenging to forecast. An optimistic outlook anticipates the emergence of a new form of multilateralism, updating the historical Bretton Woods agreements and incorporating the perspectives of additional economies such as those from the global south, without placing undue expectations on the United States. Ultimately, though the collaborative ecosystem may not be perfect, a cooperative approach is essential for progress. To other business stories, the United Kingdom economy grew by a more than expected 0.3% in November, better than a very modest growth figure of 0.1% that analysts thought they would see. Services and production both grew in November by 0.3% and 1.1% respectively. Meanwhile, construction fell by 1.3% in the same month. Germany saw a 0.2% GDP growth in 2025, marking its first annual increase since 2022 and indicating gradual recovery from recession. This matches the central bank's forecast, even as economists expect Chancellor Merz's debt-funded investments in infrastructure and defense to boost growth further this year. OpenAI has agreed to purchase $10 billion in computing power from Cerebras Systems, a startup focused on AI infrastructure. Cerebras will provide 750 megawatts of power over 3 years, supporting OpenAI's goal to diversify hardware and boost chatbot response speed. Fourth quarter earnings are coming in. Taiwan semiconductor manufacturing exceeded expectations with a net profit of $16.02 billion, up 35% year over year. Notably, TSMC forecasted annual capital expenditures of $52 to $56 billion for this year, surpassing both market expectation and last year's $40.9 billion, indicating strong confidence in continued artificial intelligence chip demand. Delta Airlines stock was falling early on Tuesday after the airline beat earnings expectations but issued disappointing guidance for the year ahead. Delta reported adjusted earnings per share of $1.55 on revenue of $14.6 billion in the fourth quarter. Analysts were expecting earnings of $1.53 per share on revenues of $14.7 billion in the fourth quarter. BlackRock's funds attracted a record $698 billion in net inflows over the year, raising its assets under management to an all-time high of $14 trillion. The fourth quarter alone saw record net inflows of $342 billion, according to the statement from CEO Larry Fink. The asset manager has strengthened its position through several major acquisitions. Goldman Sachs exceeded expectations for fourth quarter profit, with equities trading and asset and wealth management generating nearly $900 million more in revenue than anticipated. Fourth quarter earnings were reported at $14.01 per share, surpassing the expected $11.67 per share. However, revenue totaled $13.45 billion, slightly shy of the forecasted $13.79 billion. Morgan Stanley also outperformed expectations in its fourth quarter results, driven primarily by robust performance in its wealth management division. Earnings per share reached $2.68, surpassing the anticipated $2.44, while revenues stood at $17.89 billion. The investment banking segment demonstrated renewed strength, supported by an increase in mergers and initial public offerings. JP Morgan Chase's fourth quarter earnings led to a 4.1% decline in its stock price. That was on Tuesday, underperforming the broader market. This decrease was attributed to lower profits stemming from its new credit card partnership with Apple, which reduced earnings per share by 0.6 dollars. Additionally, investment banking fees were disappointing, falling 5% year over year, an uncommon occurrence for the bank, according to analysts. Meanwhile, Wells Fargo reported weaker than expected revenue, whereas Bank of America and Citigroup both surpassed their consensus estimates. Recent earnings releases from major banks indicate continued strong performance, with executives expressing optimism regarding the outlook for the U.S. economy in 2026. While there have been some declines in some cases in investment banking fees, both consumer and business activity remain robust, and ongoing business initiatives continue to support growth. Bankers say Trump's proposal for a one-year 10% cap on credit card rates could limit consumer access to affordable credit. While consumers are frustrated by high interest rates, experts argue that 10% is too low for lending to riskier borrowers. Some believe Trump aims to appeal to progressives with populist measures before the upcoming midterm elections. Oil prices have experienced significant volatility in recent weeks. Oil prices pulled back as geopolitical tensions surrounding Iran seems to be easing, and Brent sank over 4%. That was yesterday, as a larger than expected rise in U.S. crude inventories also weighed on market sentiment. Also, as the prospect of resumption of Venezuelan oil exports adds further pressure on supply. The dollar reached a 6-week high on Thursday after data showed that the number of Americans filing new applications for unemployment benefits unexpectedly fell, further boosting expectations that the Federal Reserve will keep rates on hold for the next several months. State unemployment claims fell by 9,000 to seasonally adjusted 198,000 for the week ending January 10. According to the Labor Department, analysts had expected 215,000 claims. Also in the US, December consumer price inflation was 2.7% and unemployment stood at 4.4%. Despite tariffs and a lengthy government shutdown, the economy outperformed expectations, growing by 2.1%, according to the latest World Bank estimates, compared to an earlier forecast of 1.4%. US retail sales rose 0.6% in November to $735.9 billion, outpacing October's decline and beating analysts' expectations of a 0.4% increase, according to the Commerce Department. Despite signs of economic fragility and uncertainty in policy, consumer spending, which accounts for over 2/3 of the economy, remains strong. And in Nigeria, Finance Minister Wale Edun yesterday said the country has entered a phase of economic consolidation after 2 years of reforms that helped steady inflation, stabilize the currency, and lift consumer confidence. The minister saw GDP growth at 4.68% for 2026, with inflation expected to average 16.5%. He also emphasizes the need for sustained, inclusive, job-rich growth. He added that this year, reforms will focus on digital revenue collection and pro-poor tax measures. Earnings were the big catalyst for stocks yesterday, as we saw the Dow rise 293 points or 0.6%, while the S&P 500 and Nasdaq Composite each gained 0.3%. Asian markets closed somewhat mixed, even as Asian chip stocks climbed, lifting several regional markets. Well, that's it on this special edition of Global Business Insights. This is Bode Oshosami, and don't forget to kindly subscribe and hit the notification button. Thanks for watching. Bye-bye.